The biggest one is is now a good time to be invested? Should we raise more cash or should we get out of the markets? I don't know if my portfolio can take a hit or weather the storm. So those are the big questions that we get.
Welcome to the Financial Foundations podcast, your gateway to the fascinating realm of finance, brought to you by Base Wealth Management. In this show, we delve deep into the world of money, guided by seasoned experts who will unravel the complexities of finance and provide you with invaluable insights and practical advice. Now, here are your hosts, Dustin Taylor and Alex Wolfe.
Welcome back to the Financial Foundations podcast, brought to you by Base Wealth Management, where we are the foundation to your financial plan. I'm your host, Dustin Taylor.
I'm your co-host, Alex Wolfe, certified financial planner.
As you probably already know, there is a presidential election this year. And so we thought it would be a good idea to discuss what happens typically to the market during an election year and what is some advice that we can give to make the most out of your money. So let's get started. Alex, how have you noticed clients and prospects feeling during the election year when they speak to you?
I'm sure it's not all that surprising to hear this, but we've heard quite a bit of concern as we're a fairly divided country between the political parties, which is not unexpected when you have an election year. You have people on both sides who are concerned. And our goal is to take some of the emotion and bias out of an election and really help them understand the fundamentals of investing are just as critical in an election year as they are the year after. And there's really not a big difference, but we're going to talk about some things that we know to be true and some of the concerns that we're hearing.
What are some typical questions that you're asked about investing during an election year?
The biggest one is now a good time to be invested? Should we raise more cash or should we get out of the markets? I don't know if my portfolio can take a hit or weather the storm. So those are the big questions that we get. And it seems like there's some people on the ledge and we want to try to talk to them about staying invested and why. Another question that we have been hearing is there a better investment or what can we do to our portfolio to position ourselves in a better situation?
All right, so let's get into some of those questions there. What does the market typically look like during an election year?
We have a long history of statistical data to look at, and repeatedly, as history often shows us, election years can be somewhat volatile at the beginning, and there are sometimes losses toward that election as the markets sort out who is going to be the candidate of choice. But then after the election in November, December, the market actually is positive after digesting the election results, and any losses that were incurred before the election, if there were any, and oftentimes there's not, you gain that back. And in the first year of the presidency is a good year in most historical cases.
So I think what you're saying is if I'm an investor and I pull my money out of the market because I realize it's an election year at the beginning of the year, then I'm going to miss out on those potential gains at the end of the year. And if I stay in the market, but I start to get nervous towards like the middle of the year and I pull my money out then I've actually went into the negative before the markets had a chance to recover.
Yeah, exactly. Which plays into one of our biggest philosophies is not ever trying to time the market. And this is something that I preach, other advisors in the industry preach over and over again. And it's about the time in the market versus trying to time any type of market correction or volatility. And as you alluded to, one of the biggest risks if you do get out is not getting back in time and losing out on some of the best returns in the market, which are right after a time of volatility or a big drop in the market, which we're not going to see this year. And most likely is a big correction. It hasn't happened in an election year. And it would be quite the shock if we saw a big dip in the market in 2024.
And according to historical data, how is the market affected by who wins the election?
This is a great question and a great case study for those who are interested in reviewing the historical market returns based on who is elected, Republican or Democrat. And the conclusion you'll come to is there's not a big difference. If a Republican's elected versus Democrat, the market returns are very similar, which shocks quite a few people. But one thing that you need to remember is some of those market returns are based on those specific presidential policies that they pass or try to pass that can affect market returns. And then also, is it a divided House and Senate in Congress, or how those other elections play out too can vary the market returns, not really so much so with the actual president.
Okay, and you mentioned some policies may affect the market. What type of policies affect the market?
A topic that is often discussed during elections and during a president's cycle is foreign policy. So in 2016, when Trump was elected, his main goal was to make America great again, and by shifting jobs back to the U.S., and he was really harsh on foreign policy and trade, which has an impact on market returns and international returns. And it's not always that favorable. You would think like, oh, it's great because we're going to bring jobs back to the U.S., but it's at a cost, which is great for the economy in one way where you're supplying jobs, but people are paying more for those goods and services because the companies are having to pay more for those employees versus offshoring it to other countries.
So how are you coaching or talking to clients about this?
As I mentioned kind of in the introduction, is trying to remain unbiased and take some of the emotion out of investing during an election year. And what you want to do is continue to maintain a properly diversified portfolio and actually make adjustments based on economic conditions and take the election out of the way you're going to position your portfolio in 2024. So the bigger discussions are, okay, it's an election year, great, but that really doesn't have a large impact on your stock market and the economy in that year. So the things that we're talking about is, how is the economy doing? Is GDP still trending upward? Are we going to see any interest rate cuts? Which we've been talking about interest rates for a long time. We mentioned it on almost every single podcast, and how that impacts market conditions and future rate increases or decreases or nothing at all, and how they can take advantage of market conditions based on the economic indicators versus who do we think is going to win the election. And I hope the takeaway from our listeners today is it really doesn't matter which candidate gets elected. The market returns would likely be very similar regardless.
So we've talked about what investors can do, and that basically, I think to sum it up, it is to stay in the market. But what do you do as a financial planner to protect clients' portfolios and account for that volatility?
So one thing we do, especially if someone is just getting into the market, is dollar cost averaging. And what that means is you set a sequence where every month or every quarter, you put a portion of their portfolio into the market. So they're like you're contributing to your retirement plan when you're doing it on a paycheck basis or every month. That's a dollar cost averaging strategy, and your returns are much more likely to be stable versus going through the ups and downs on a day-to-day basis. So for someone who's already gone out of the market, or we just couldn't talk them off the ledge, to try to set them up with a strategy to get back in. And that inward strategy can be putting in a portion every month back into the market. And that will help reduce some of that volatility, but getting them back into the market without trying to time that specific point where they think they're at the bottom, because you just never know. The other strategy that we use, and regardless of an election year or not, is proper rebalancing, where if you see market returns are really strong in growth stocks versus value stocks or bonds, is properly rebalancing, so that way you don't get overly aggressive unintentionally. So some people, through market returns and natural drift, your portfolio starts leaning more heavily into growth stocks without you knowing, because those returns are typically much better on a year-to-year basis, but rebalancing and taking some of those gains off the table and putting them back into areas of the portfolio that haven't experienced that growth to get you in the proper mixture of stocks, bonds, cash.
And do you also measure portfolio risk?
Yeah, that's another great question. And something we do with a client's portfolio is we show them how much risk they're currently taking to make sure that aligns with their risk tolerance and their goals. So that can be kind of an eye-opener, especially in a year that can be volatile in our current market conditions, is making sure a client is properly allocated into a portfolio that meets their risk tolerance. And sometimes it's having a question or having a hard conversation with them so that way they understand, like, based on the risk that you're taking, these are the kind of expected returns based on the capital market assumptions for that portfolio. And someone who's maybe taking not enough risk or taking too much risk, you warn them of the reasons why maybe that's not the proper portfolio for them.
So now that we've covered various points about an election year and investing during an election year, I think that we can sum everything up in one big takeaway, and that is to zoom out. And no matter how you're feeling now during this election year, realize that when you do zoom out, that it's just a blip on the radar.
Exactly. So to your point, when you zoom out and look at the big picture in the sequence of market returns over the last 50 years, that one election year every 4 years is such a small part of the picture. And in most election years, the market is positive.
All right. If you'd like further financial insights, you can visit our website at basewealthmanagement.com.
Also, love questions. So if you have any questions, please send those to our email address at question@basewealthmanagement.com.
And don't forget to subscribe to our podcast on your favorite listening app. I'm Dustin Taylor.
I'm Alex Wolfe.
And happy listening.
We hope the expertise shared by our hosts, Dustin Taylor and Alex Wolfe, has left you feeling empowered and informed. If you're eager for more financial wisdom, don't forget to subscribe, rate, and share the show with your friends, family, and colleagues. Until next time, stay sharp in the world of finance.